The SEC has yet to publicly comment on why FINRA violated their own rules or why the U3 halt was timed as it was. From a legal standpoint, the SEC is FINRA's primary regulator and has a mandate to protect investors. The lack of public comment or corrective action on FINRA's process is viewed by many as complicity in a market event that harmed investors. The SEC's ongoing investigation, which has so far focused on the former CEOs of Metamaterials and Torchlight, not FINRA, adds to this perception of one-sided accountability. A confluence of events, including FINRA's unilateral alteration of the MMTLP corporate actions and the timing of the U3 halt directly after unchecked short selling and before planned liquidations, lends significant plausibility to the widely held view of regulatory interference. And because the SEC has chosen to allow 1,000 days to pass without doing the right thing, they are now the subject of a series of videos that will highlight their involvement in the MMTLP fiasco and other events as they relate. This is The Case Against the Securities Exchange Commission, Part 1 of 5. In September 2021, the SEC issued subpoenas to John Broder and George Palikaras regarding the June 2021 reverse merger between Torchlight and Metamaterials. At the time, the specific allegations of the SEC were not publicly known. Since these subpoenas, a number of events have transpired that have had a significant impact on investors in Torchlight, Metamaterials, MMTLP, and Next Bridge Hydrocarbons. We'll start with the options chain that developed in Torchlight just a week before the reverse merger. The issuer was not involved in this process, and more than 4 years later, there has been no cooperation in divulging the parties responsible. This was significant because the options chain resulted in multiple OCC memos that, while not widely distributed, informed certain market participants that the settlement of the Series A preferred shares, which would later become known as MMTLP, would be delayed. The OCC memos also noted that the company had no desire for a market to develop for the Series A preferred shares, but the memo appeared to suggest that one might develop in the future. The trading of MMTLP. In October 2021, MMTLP became tradable. The OCC memos acknowledging this informed market participants of the change and updated them on how the settlement process was modified as a result. When the Series A preferred shares became tradable, it caught the issuer and investors off guard. Many investors likely believed that the value in their accounts, when MMTLP began trading in the 10-cent range up to about $3, was the dividend value they were promised, and some investors sold. The price fluctuated, but gradually leveled off to about the $1.50 range for the majority of the time that MMTLP traded. Initially, there was very little comment from the issuer, which by this point was Metamaterials, because they themselves were not sure what was going on. We later learned that John Broder contacted OTC Markets to complain about the Series A shares trading, and that the information used was outdated and inaccurate. I believe the response he received was that he had no standing and that it needed to be taken up with FINRA. We also learned that George Palikaras contacted FINRA in October 2021 to complain about MMTLP trading, but FINRA refused to remove it from trading. This is in contrast to a similar complaint Palikaras made about a Canadian component, which was addressed and rectified immediately. They also weren't told which parties were responsible for making the shares tradable, which was very similar to the TRCH options chain situation. The only option I believe Broder and Palikaras were offered was to update the information, but they declined. As time went by, Metamaterials acknowledged that MMTLP represented the Series A preferred shares and that the entitlement to the assets was transferred in each transaction. Metamaterials began a process in July 2022 to spin off MMTLP into a private company that would later be known as Next Bridge Hydrocarbons. The SEC was directly involved in this S1 process, which involved multiple amendments that required the maximum amount of time allotted between each, mostly for minor changes. It is important to note that this process took place while the SEC was investigating John Broder, George Palikaras, and Metamaterials regarding the reverse merger. This ongoing investigation, and the fact that the public did not know the exact details, potentially impacted whether investors decided to invest in Metamaterials and/or MMTLP. However, the fact that the SEC eventually made the S1 effective led many to believe that the investigation might not result in charges. After all, why would the SEC allow investors to invest in Metamaterials directly after the reverse merger, and then in MMTLP, and also make the S1 effective to spin off into Next Bridge if they believed Brda and Palikaras were guilty of a serious crime? MMTLP had already increased gradually, seemingly as a result of initiating the spin-off process, and the peak came on the Monday directly following the SEC making the S1 effective. This appears to show that while some investors might have sold their shares, the majority seemingly held and possibly bought more along with new investors that never held TRCH. This was harmful in a way for the original holders of TRCH, who knew at the time that the only way to get the Series A preferred shares that would later become MMTLP was to buy TRCH before the reverse merger and hold through the process, even though the price reached the low double digits. Just imagine those that bought TRCH in the $11 range to get the dividend. Their surprise when they saw it on sale for about 10 cents when it initially became tradable, and mostly under $2 for the majority of the time it traded. The SEC couldn't have been oblivious to the circumstances relating to MMTLP becoming tradable because we know they were investigating the reverse merger. We just didn't know why. We do know that the SEC would have been well aware of the fact that investors needed to hold TRCH to get the dividend. So they would have had a front row seat to observe that some investors paid over $11 in order to receive a dividend, which of course also came with a reverse split allocation of MMAT, but others were getting the dividend for well under $1. If their eyes were already on this, why didn't they intervene? FINRA and the corporate action with the S1 to spin off MMTLP into the private, non-tradable Next Bridge Hydrocarbons now effective. The next step was for FINRA to review the submission from Metamaterials and publish the corporate action to their daily list. This process is known to take time, but we also know that FINRA was already involved in the process, particularly showing interest in the SEC's investigation into the reverse merger. It's well known that investors were calling FINRA for updates as to when, or even if, the corporate action would be published, because the final trading details were important. We needed to know our last opportunity to trade because this would determine our last opportunity to buy or sell before the shares were exchanged for Next Bridge Hydrocarbons. After that, there was no telling how long our investment would be illiquid. So think about this. If a regulator's role is to protect investors, which basically means making sure they have access to their money, how could FINRA and the SEC believe it was an acceptable outcome to force investors to be invested in a private, illiquid company? The first MMTLP corporate action informed the market that MMTLP shareholders with settled positions as of the December 12th record date would be entitled to receive 1 share of Next Bridge Hydrocarbons for every share of MMTLP held on the December 14th pay/distribution date. For a position to be settled as of the December 12th record date, the last day to open a new position in MMTLP and still be qualified to take part in the exchange would have been December 8th. So from the opening line, the corporate action department of every participating brokerage should have known to not allow new buys in MMTLP after December 8th. If this wasn't obvious enough, the corporate action also included a line that specifically said that purchases of MMTLP executed after December 8th would not receive the distribution. It wasn't the responsibility of the investor to interpret this, though it is in their favor to know how to read a corporate action. It was the responsibility of each brokerage's corporate action department to read this and understand that they should not allow their clients to make new buys in MMTLP after December 8th. The 2 main features of the corporate action that appeared to have caused the most confusion were that the MMTLP shares were to be cancelled effective December 13th, and the overall 0-hour December 13th effective date of the corporate action, which aligned with the effective December 13th share cancellation date and time. The shares being cancelled the very moment December 12th transitions to December 13th, the 0-hour, makes it impossible to be a holder of MMTLP on December 14th. Both Metamaterials and Next Bridge Hydrocarbons informed the public that the MMTLP shares were to be cancelled immediately following the distribution of the Next Bridge Hydrocarbons shares on December 14th, after the close of business, New York City time. This was not complicated. This was not an easy mistake to make, especially when FINRA has a Rule 6490 that governs its process for reviewing a corporate action submission. But this wasn't just a matter of a mistake slipping past multiple individuals who likely reviewed this corporate action as a team. We would later learn that the wording of the corporate action was given to Metamaterials, along with the directive not to question anything contained therein. So when Metamaterials issued a PR concerning the corporate action, they included the wording published to FINRA's daily list. But there was a difference. In between brackets and in all caps, right after "will not be quoted X", it says no X dividend date in the PR. But this did not appear on FINRA's daily list. The inclusion of no X dividend date served as an explicit and direct communication to the market that the standard rules and expectations surrounding an X dividend date did not apply. This was a necessary clarification for several reasons. A key function of an ex-dividend date is to adjust the market price of a stock to reflect the value of the dividend that has been paid out. But since the MMTLP shares were being cancelled and would no longer trade, there was no ongoing market in which to reflect this price adjustment. The corporate action was a terminal event for MMTLP. The focus was on a final settled position as of the record date to determine who would receive the Next Bridge Hydrocarbons shares. The concept of an ex-dividend date, which governs future trading, was irrelevant. By explicitly stating no ex-dividend date, the version of the corporate action in the Metamaterials PR aimed to prevent investors from making trading decisions based on a misunderstanding of the corporate action's mechanics. It was a clear signal that this was not a typical dividend scenario, and to reinforce this idea, they encouraged investors to seek clarification from their brokerages, and that's what investors did. Here is a response from TD Ameritrade on December 7th. Hello, thanks for the email. This is what we know at this point. MMTLP shareholders as of record December 12th will receive 1 share of Next Bridge Hydrocarbons for every share of MMTLP. Purchases of MMTLP executed after December 8th will not receive distribution. Will not be quoted. FINRA verified it will be cancelled December 13th. See below. The stock will quote on OTC dealer on Friday, December 9th and Monday, December 12th, but according to FINRA, anyone buying on those days will not receive distribution and the symbol will be cancelled effective December 13th. We will be setting MMTLP to closing transactions only after close of trading tomorrow, December 8th, as purchasers after that point will not be entitled to shares of Next Bridge. I hope the information helps. Kind regards, Pasquale R. Trader Support, Trader Services. This message is crucial because even though it isn't dated, when he noted that TD Ameritrade will be setting MMTLP to closing transactions only after the close of trading tomorrow, December 8th, we can conclude that this message was sent on December 7th. At this point, there was only the first MMTLP corporate action in play, so everything referenced here came either from the first corporate action, the Metamaterials PR, or apparently from FINRA, as he mentioned that FINRA verified it will be cancelled December 13th. We also notice here that he's referencing information from the daily list version of the corporate action, because after "will not be quoted X", he didn't mention the no ex-dividend date portion that was in the Metamaterials PR. This is skipping ahead a little, but according to this message, it looks like TD Ameritrade sought confirmation from FINRA concerning the December 13th share cancellation date. According to Google Gemini, this is most likely how this would have worked back then. The following information is based on the process as it would have existed in December 2022, before the significant update to the Corporate Actions Management Platform, which went live in late 2023. The process of confirmation. In December 2022, if a major brokerage had an OTC corporate action and needed to confirm the details, particularly a share cancellation date with FINRA, the process would have been a combination of standardized procedures and direct communication, likely involving phone calls and emails. 1. Initial internal review. Before contacting FINRA, the brokerage's internal corporate actions department would have first reviewed the official corporate action notice published by FINRA. This notice is what provides the market with the key dates and details of the action. The brokerage would also have received the S1 filing and any related communications from the company itself. The brokerage's corporate actions team is responsible for interpreting these documents, and setting up the internal systems to process the event correctly for their clients. If there was a discrepancy or a point of confusion, like the share cancellation date, that would trigger the need for external confirmation. 2. Who calls from the brokerage and from what department? The confirmation process would be handled by the brokerage's corporate actions department or a similar team responsible for processing these events. This is a specialized back-office function. The individual making the call would be a team lead or a senior analyst who has direct knowledge of the specific corporate action in question. This is not a task for a customer service representative or a retail broker. The purpose is to ensure the brokerage's systems are programmed correctly to handle the event for all of their clients. 3. Who do they call at FINRA? The brokerage would contact FINRA's operations department, which is responsible for reviewing and processing corporate actions. They would have a direct line of communication or a specific contact for such inquiries. The process for a large, established brokerage would be more streamlined than for a small, unknown entity. It's not a generic customer service line, it's a specific channel for industry participants to communicate about operational matters. 4. The nature of the communication. The communication would be direct and formal. While a phone call may initiate the contact, it's highly likely that a written record would be created and maintained, most often through email. Initial inquiry. The brokerage representative would explain the specific corporate action, for example, the MMTLP spin-off, and the point of confusion, for example, the share cancellation date. They would state what their understanding is, based on the published notice, and what they need to confirm. For example, we are calling to confirm that the share cancellation date of December 13th is correct as published, as this is an unusual event. FINRA's confirmation. A FINRA representative would review the file and the internal data associated with the corporate action. They would then respond to the brokerage. In this scenario, they would confirm that the date is indeed correct. This confirmation would be a direct statement, likely backed by the official documentation on file. Documentation. An email or internal memo would be generated to memorialize the call. This is a critical step for a brokerage to protect itself from liability. The email would state something to the effect of, "On date, I spoke with FINRA contact in the operations department regarding the MMTLP corporate action. They verbally confirmed that the share cancellation date of December 13th is accurate as per the notice. This ensures there is a clear, auditable record of the due diligence performed." In December 2022, this process was not automated or managed through a single, unified digital platform in the way it is now. The communication was more decentralized, reliant on direct professional relationships and careful documentation via phone and email. This is precisely why a single word or a date published in an official notice could have such a significant impact, and why it was so crucial for brokerages to seek confirmation when an aspect of the notice seemed out of the ordinary. And at this point, we return to the December 7th message from TD Ameritrade. There is only a little confusion because a little later in the message he says that the symbol will be cancelled effective December 13th. But since he used the keyword cancelled, and since there was only one corporate action at the time, I think it's safe to say that he was referring to the shares. But regardless of what he meant, and regardless of FINRA, including an incorrect share cancellation date, TD Ameritrade traded perhaps the largest volume of MMTLP, and they were allocated close to 54 million shares of Next Bridge Hydrocarbons when the shares were distributed. Combine this with the 12 million from Charles Schwab, and their 66 million shares account for approximately 40% of all MMTLP/Next Bridge shares that legally should have been in existence. Charles Schwab was founded in 1971, and TD Ameritrade shortly after, in 1975. I only include this information to reinforce that they probably knew what they were doing by December 2022. We would later see that their messaging regarding trading MMTLP in the final days was pretty much the same, even after the corporate action was revised. The revision included a number of changes, but rather than addressing them now, I mostly want to focus on what was mostly the same. The corporate action still said that MMTLP positions needed to be settled as of December 12th to be entitled to the distribution. It also still included the line about purchases of MMTLP executed after December 8th, not receiving the distribution. One major change was including symbol deletion effective December 13th instead of share cancellation. But since there was no update in reference to share cancellation, what were they supposed to think? So if this same information was included, and we know that FINRA knew what the brokerages were communicating to their clients, that they weren't going to allow new buys in MMTLP after December 8th, then there's no justification for FINRA claiming they needed to U3 halt trading in order to protect unsuspecting investors from making new buys in MMTLP after December 8th. The UPC notice that followed the U3 halt informed the public that, pursuant to Rule 6440(a)(3), FINRA has determined that an extraordinary event has occurred or is ongoing that has caused or has the potential to cause significant uncertainty in the settlement and clearance process for shares in MMTLP, and that, therefore, halting trading and quoting in MMTLP is necessary to protect investors and the public interest. The trading and quoting halt will end concurrent with the deletion of the symbol effective Tuesday, December 13th, 2022. So FINRA U3 halted trading due to an alleged issue related to settlement and clearance, which wasn't a result of anything that wouldn't have already been apparent during the two Rule 6490 review procedures that FINRA would have been responsible for conducting before publishing the two separate MMTLP corporate actions. Is this believable to you? Even though FINRA hasn't admitted this, the fact that they included an incorrect share cancellation date and overall effective date in their initial December 6th corporate action indicates that FINRA's Rule 6490 failed to prevent the publication of a deficient corporate action. Then, based on the reasoning included in FINRA's UPC halt notice, FINRA failed to identify an issue related to settlement and clearance in the revised corporate action, which is one of the criteria according to their Rule 6490 that they are supposed to identify and address before a corporate action can be published. Furthermore, rather than allowing time to possibly address whatever issue related to settlement and clearance that FINRA claims they only discovered directly before brokerages planned to begin closing transactions only trading and potential forced liquidations, FINRA included in the UPC notice that the halt would end concurrently with the deletion of the trading symbol effective December 13th. This, of course, meant that the halt would end with an action that would prevent any further trading from being possible. In other words, a never-ending halt. Not only this, but unless I'm mistaken, the trades initiated on December 8th wouldn't be able to settle properly, especially the positions that were shorted. So if one of the reasons to halt trading was to protect a hypothetical handful of investors that might have somehow been able to make a new buy after December 8th, why was the only solution to sacrifice the actual investors that already held the security? There were over 65,000 investors that have been holding their investments since TRCH. Some for multiple years, not just leading into the merger. It doesn't make sense. The halt came before the December 9th trading day began. This meant FINRA and the SEC had the entire day of Friday, December 9th, possibly Saturday the 10th and Sunday the 11th if they ever worked weekends, and the entire day of Monday, December 12th, to possibly contact the issuer, sort out whatever issue they discovered, revise the corporate action again just the way they did on December 8th without requesting input from the issuer, and then notify the market and investors of the solution they worked out to protect all investors and maintain market integrity. They didn't do any of this. They just immediately decided that the only solution was to never allow trading beyond December 8th, and whoever held a long position, a short position, and even a naked short position, all of those positions would presumably be transferred and reflected in Next Bridge Hydrocarbons, a non-tradable, non-DTC eligible security. The aftermath and hit pieces. Something else that occurred directly upon the completion of the spin-off, if we want to call it a completion, is that the SEC filed charges against a group of retail investors that allegedly operated a pump-and-dump scheme involving multiple securities. At the time, though many outlets reported about the charges, websites like InvestorPlace chose to use a headline that implied Metamaterials was linked to the pump-and-dump. The reality was that it was actually the shares of Torchlight that were allegedly pumped by this group, but it was strange that Metamaterials was the only security that they focused on. and the timing occurred on the planned distribution date of Next Bridge Hydrocarbons, as well as the true date that MMTLP was to be cancelled, December 14th. The Investor Place article was very much a hit piece, and it wasn't the only one aimed at Metamaterials, Torchlight, MMTLP, both during and after it no longer traded, and Next Bridge Hydrocarbons. The goal of a hit piece in most cases is to trigger a sell-off. When the negative information spreads, retail investors and sometimes even institutional investors may panic and sell their shares, driving the stock price down. As the price falls, the short seller can buy the shares back at a lower cost, cover their short position, and realize a significant, illicit profit. The success of the campaign hinges on the ability of the hit piece to create a price drop large enough to be profitable for the short seller. Key characteristics of a hit piece include pseudoscientific or deep dive tone. The report is often structured to look like a legitimate research report, with charts, footnotes, and a professional layout which can deceive an unsuspecting reader. Selective and out-of-context information. While it may include some true facts, they are often taken out of context or combined with false claims to create a misleading narrative. Sensational and clickbait headlines. The titles are designed to grab attention and imply a massive scandal or imminent corporate collapse. The entire practice is a form of securities fraud. The SEC, DOJ, and other regulators are supposed to actively investigate and prosecute short and distort campaigns because they harm investors, disrupt the fair price discovery process, and can cause significant damage to companies. To my knowledge, there have been no investigations into any of the hit pieces seemingly aimed at the securities in question. So, although Next Bridge Hydrocarbons knew there was the looming issue of not exactly knowing who their shareholders were, they did carry out their obligation of facilitating the distribution of the Next Bridge Hydrocarbons shares. And while it would have been ideal if all shareholders had their shares at the transfer agent, this was not the case. The majority of the shares were still in the custody of the approximately 105 brokers that either allowed MMTLP to trade or had clients who received shares as a result of holding TRCH through the reverse merger. This is not the end, we're barely getting started. This is only part one of what looks to be maybe 5 videos with a similar runtime, focused mainly on the missteps of the SEC in this whole fiasco. I promise you it gets worse.